the highlights here. Obviously, subscribers far and away beating estimates. Also, the forecast for subscribers beating estimates, but the earnings forecast a little bit light.
Yeah, I mean, the thing with Netflix is that the investors always look at the subscriber number. It doesn't seem to matter what's happening with the revenue or their earnings. By and large, the revenue story for Netflix has been one that's pretty positive because they are boosting the amount of revenue that they get per subscriber, which means that each subscriber that they sign up should be a kind of a net positive for them. But the takeaway, as always, is the subscriber number. They're on pace to add almost 29 million customers this year. I went into this quarter thinking it was possible that they would report a decline in subscribers this year if they had a miss. Instead, they're going to post their biggest year ever by about 5 million. At a certain point, you run out of superlatives to talk about the growth, at least in terms of customers, this company is delivering.
So, Andre, when you look at the data across Optik, what do you believe is driving this? Is it these new Netflix original shows?
No, I don't believe it's the new Netflix original content at all. I think there's a certain, part of the success of Netflix that can be attributed now, definitely over the last few quarters, to just a rising tide, floats all boats. The growth that we're seeing across over-the-top and connected TV, not just domestically in the U.S., but in pretty much every broadband, internet-connected, market in the world is just phenomenal. And I think at some point, the street has to stop looking at Netflix from the standpoint of just did they hit or miss their own estimates in terms of what growth is going to be, and really just look at it as a normal company. I think there's three things that I would be really worried about in terms of the future if I was Netflix, regardless of really whatever the story was this quarter, and that would be AT&T, Disney, and then free OTT solutions. The value and the demand for the content that HBO and the Warner Media will have when they launch their solution, Disney content, and then just the massive growth of free ad-supported OTT is even more significant, I think, than what we're seeing from Netflix the last few quarters.
Lucas, given that Netflix is so far ahead of other streaming providers at this point, do you share those concerns that it's about AT&T, about Disney, and other free over-the-top competitors?
I think the free one is not really a concern for Netflix. They've competed for the last 10 years with a pretty popular free ad-supported service called YouTube, and both companies have done just fine over that period. The competition from Disney and from AT&T is very real. Those two companies have huge troves of library that's very popular. They are both going to be pulling back movies and TV shows from Netflix to boost their own services. The Netflix counter would be that, one, that they've been building a studio over the past few years. It's something they talk about in their letter to shareholders today. And their biggest hit as an original show, Stranger Things, is something that they made themselves. It's not something they got from another studio. And then to Andre's own point about sort of a rising tide, I think you can see AT&T and Disney grow without it necessarily hurting Netflix. There'll be a lot of competition in the developed Western markets. But I think overseas in particular, Netflix is going to be really far ahead of those companies, and I don't know how much of a threat they'll be in a place like Brazil.
I'm looking at a chart right now on the Bloomberg Top Live blog where we're following Netflix results. This is a chart of Netflix margins, which appear to be very strong, Andre. That said, if it's not a result of the original content investments, are those investments in original content worth it? Because Netflix is warning about its negative free cash flow, and it has a note in its results today to investors that they recognize they're making huge investments in content, but that they believe this investment is worth it and will pay off over the long term. But is it?
The team at Netflix is very intelligent, and they saw, kind of the economies of scale changing 3-4 years ago when they really started to make their investments. So, Netflix knows they have no technological barrier to entry. So at some point, with just the proliferation of OTT and connected TV, the providers of content that they rely on would eventually bring that in-house. And that's really why they've been preparing this original content strategy for quite some time. So what I will disagree on, though, is, looking at YouTube, which which with the overwhelming majority of the content is user generated as competition is really, not viable. Now what you're seeing across free ad-supported solutions, whether it's, Pluto TV or Tubi TV, is high quality, professionally produced content licensed from the MGMs and the Sonys and the Warner Brothers and others. And that's where domestically in the US, the majority of the unique household growth has been over the last 20 months or so. And then in international markets, it's really not so much having to worry about the Disneys or the AT&Ts. It's the Globo TVs in Brazil that own all the popular telenovela rights, or the iFlix in India. And Netflix has had problems competing in these markets. And so my concern is, in order to compete on 100 different fronts at once and having original content in the native languages and different genres, the amount of money that Netflix is going to have to spend on content over the next few years is it's so unprecedented that I would be concerned if I were at Netflix.